Financial Agreement, Finance section of CFO100. As the first step to understanding the financial agreement, you need to understand the nature of the two types of financing. As a person of account or a financing manager, you already know financial agreements, but you should understand clearly those two categories again. Those divisional managers know how to manage the cash and how to recognize it in the books of account, but they don't understand the legal point of view for financial agreements. You need to understand not only the numerical perspective, but also the content of the agreement, because such knowledge works well when you negotiate with the bank to arrange new financial agreement. You can divide financing instruments into two categories very simply. The first one is short-term finance, and the second one is long-term finance. Short-term finance includes working capital facility, revolving credit, LC account, and demand draft also. The purpose of those instruments is to cover a shorter period of funding within 1 year. The nature of this instrument covers the demand of regular daily operations. As the length of credit is short, the interest cost is also relatively low. Financial agreement for those instruments is simple and has a small number of negotiation points. On the other hand, long-term finance has different nature. This category includes long-term facilities over 1 year, corporate bonds issued by companies, and shareholders' loans as well. As this type of finance has long period coverage, there are some additional risks on the table. That is why there are some additional clauses in the financial agreement. You need to keep in your mind that there is a particular character in long-term finance. Usage is usually not limited strictly. Interest rate higher than short-term one. Tax and forex perspective should be considered more. The financial agreement of long-term finance also has a standard draft, but it tends to be an order-made agreement for each specific ones. Since the agreement sometimes covers more than 5 to 10 years, a detailed check of the agreement is necessary to engage the new one. The legal and CFO must collaborate. In the next slide, you can understand the contents of short-term financing. A working capital facility is a good example for which the relationship between borrower and lender is very simple. The lender gives a fund to the borrower, and the borrower pays back the principal and interest to the lender. When you engage in this type of agreement, there are 3 points to pay attention to. First, it contains a clause for limitation of drawdown, and also there is a limitation of usage. For example, you can draw down funds from the facility for limited times in a year, and you are restricted to use the fund only for a limited purpose. It means that the company cannot use the fund for buying facility on a long-time basis. The second aspect is that there is a penalty for early repayment. If the company borrows money from lenders, setting a particular period and the company pay back the principal earlier than the engaged period, the company must pay the penalty to cover the opportunity loss of interest income as a lender. Of course, there are different agreements, but this type of limitation is ordinal in this type of instrument. Lastly, agreements tend to contain minimum drawdown commitment. It means that the company needs to draw down more than the settled amount to secure interest income for the lender. If the amount is lower than the minimum borrowing commitment, the company must compensate the lender. Limitation of rollover is also general covenant. It is sometimes defined by governmental regulation in each country. Due to this clause, you cannot roll over the instrument. You pay back it and draw down it as another fund. Those three aspects are a common issue for short-term finance, but you find the same aspect in long-term financial agreement. So those points are basic points you should pay attention every time. The important message is that you need to pay attention not only to economic cost, but also the detail of clause covering those specific points to avoid any risk and difficulty for the daily operation. Borrowing money at a low cost is important, but when you compare lenders, you must see those legal point of view. After understanding the basic structure of short-term finance, you become able to understand the long-term finance agreement. In this slide, we pick up external loan from the bank as an example. There are three important points to keep in your mind when you design long-term financial agreement. And also, you need to have image of how the financial agreement establish relationship with the stakeholders. The first one is guarantee and collateral. This type of loan usually requires a guarantee or collateral because banks don't want to take much risk on a long-term basis. Parent guarantee is a very basic way to cover this point. If you are the shareholder of the borrower, you should arrange the guarantee on a pro rata basis with your business partners, not only by you. From the borrower's point of view, you should negotiate with the bank regarding the low interest rate because the parent guarantee has much credibility to obtain a lower interest rate. At the same time, the borrower needs to take care of paying appropriately guarantee fee to its parent companies. Once the parent receives the fee, the fact raises transfer pricing issues. The second important point is covenant and restriction. Giving credit to borrower long-term period means much risk for the lender, so the agreements tend to have many clauses to mitigate lender side risk. The most basic point is the restriction of change of shareholders. DSCR and net worth level are also typical covenants. The lender set the targets and the borrower has to comply with the condition. The lender requires a right of suspension and default clause in the agreement. CFO should discuss with the legal division to take care of detailed description, and you need to check if that requirement is reasonable and not harmful to your operation. The third point is currency and hedging. As the period is long, there is a fluctuation risk of the forex. For example, you borrow money from the bank on a US dollar basis and inject the money into your subsidiary in China at renminbi basis. This borrowing has forex risk because you need to pay back US dollar to the lender, but the money has been transformed to renminbi and income currency is also renminbi. In this case, to match the borrowing side and the revenue currency, you consider a swap loan. The borrowing facility is defined US dollar, but the money has been swapped into renminbi and the payback amount is also fixed as renminbi. Long-term finance tends to cover many aspects, not only relationship bank and your company, but also you need to consider the relationship with other parties. Considering that indirect effect, CFO needs to design a financial agreement. If your company issues a corporate bond, such a stakeholder issue is much bigger than a normal bank facility. You have learned the basic points that you need to pay attention to when you arrange the financial agreement. If you want to understand more specific clauses and details, you can learn them in another lecture at the next step. Negotiation skill is also important to learn to have good conditions in your agreement. Those tips can be also learned in another video.